Okay, we're live. How you doing, friends? It is Sunday. I believe it is September 13th, if I'm not mistaken. Yes, it is September 13th, and it's 1 o'clock in the afternoon here in the Boston area. And I'm going to give a short presentation on options stock assignment. Now, the reason why I'm doing this, and the reason why I'm doing a live presentation as opposed to some sort of prepared video, is I wanted to get it out there quickly, as it will affect our current strategy in the asymmetric options service. If you're interested in that, you can go down below. We're going to have aggressive pricing until the end of this month, until the end of our third campaign. And at that point, I'll reveal our performance and what we're doing. So anyways, one thing that came to my attention last week, we have a small experimental account that I'm using in Robinhood to, excuse me, a small experimental account in Robinhood where we're experimenting with selling puts against the SPY index. And an interesting thing happened. The SPY, of course, has been under a little bit of pressure last week, and the put option, the put spread, I put on a credit put spread, which is a bearish strategy. Always put them on at about, 92 to 95% probability of profit. With the pressure that we had under the SPY, it came down quite a bit, and it tested that strike price that I had put for the put option, for the put spread. Now, it was only temporary. It went down, then came back up, and actually ended up out of the money, and the options expired worthless, etc. But Robinhood, for a brief period of time, it did go down below, and it was in the money, which meant that it was it was at risk of being assigned stock. Now, in order to avoid that, what Robinhood will do is, if they believe you're in the money and an hour or two away from expiration, even if you're close, they'll close your position. And so they did that. They closed my position. And so instead of making a few cents on it, I lost about 18 cents. Now, it's not a big loss. And even though it ended up in my favor, I understand their risk management, their mitigation strategy. And it's all automatic. I have no control over it. Now, of course, if I had sufficient capital in that account to cover being assigned that 100 shares of SPY, they wouldn't have done anything, because from their point of view, they would have been covered. I would have had enough money, or enough marginable money in there to be able to cover the SPY trade. But that would have had to have been a significant amount of money, because SPY is a $300+ stock. I would have had to have in excess of $30-something thousand. So, and that kind of flies in the face of this sort of experimental strategy where we're taking small amounts of money, a small account, and trying to grow it big. So that got me thinking about our option strategy and what is the risk of being assigned stock. And so what I'm going to do is I'm going to do a short presentation that talks about getting assigned stock, and what that process is like, and what is the actual risk that you need to be worried about, and what are some of the mitigation strategies that you can do to protect yourself from being assigned stock. Now, getting assigned stock isn't the end of the world, and particularly in a naked put or a put credit spread, because you're in essence getting that stock at a discount. So you placed a strike price at a price that is well below the current price, and so the idea is that you should be willing then to take delivery of that stock should that price come down and meet that. And if it does go in the money, then you're going to more than likely be assigned that stock on a short position. So that should be something that should be in your head. Now, if you don't want to get assigned, there are some things that you can do to avoid it. But there's no true way to avoid being assigned, because once you open up a short position, once you create or write a short put or a short call, you are obligated at any point during the life of that options contract, if the party on the other side of the transaction decides that they want to exercise their long option, they can. Now, what we're going to talk a little bit about is, well, how does that transaction work? And it's not entirely clear to most people, so we'll clear that up. And so what we'll do right now is we'll go and we'll look at this presentation that I have, options assignment, and can you avoid it, and how would you go about doing that? Is it even possible, or is it necessary? So the process of assigning stock to a trader like yourself or myself is only going to happen, or only going to be possible, if you are on a short position of a put or a call. So in other words, you write a put or write a call, or you create a put credit spread or a call credit spread. Then you have a short position. In virtually any spread, you're going to have some kind of short position. So it equally applies to debit spreads as well. But we don't do debit spreads here in our strategy. We only do the short credit spreads because that's our specific strategy. There's, quite frankly, there is a much larger edge in what we do than trying to go long options or doing debit spreads. So when you have a short put or a short call, on the other side, somewhere out there, and it's not a one-to-one thing, because you have to remember that there is the Options Clearing Corporation, which is actually the in-between broker, the third-party administrator that is handling both sides of the transaction. So you're really dealing with them. You're not actually writing an option for some other person out there that is deciding to take that option. It's the Options Clearing Corp that is actually executing that transaction for you. And when it comes to the exercising of that option on the buyer's side, they manage that as well by trying to match up anybody who wants to exercise that option with people who have sold options. Now, not everybody exercises options. As a matter of fact, it's a relatively rare event. And I would say that probably somewhere around 2 to 5% of options get exercised. Most are just, they let them go to expiration. Now, the Options Clearinghouse, when they get a notification that a buyer wants to exercise an option, they then go through what I would call a kind of a lottery or a random process of selecting someone else who has written that option, and then they match them up, and they will then send a notification of assignment to the seller of that option that would match up with the buyer. And that notification would say, hey, look, you got assigned, we're sending you stock. And there's not much you can do about it after the fact. You get the stock, and either you have the money to buy it or you don't. If you don't, then you could be in a little bit of peril. You may get a margin call. Who knows? More than likely, your broker will probably intercede and step in and take care of the transaction and make it a monetary transaction for you. But it puts you at a bit of a risk, too, because you don't know what's going to happen after that. Now you have stock. It's essentially a leveraged position, or a lot more capital has been allocated now than you originally had with your naked call or put or your spread. Particularly with spreads, they're much more capital efficient. So you might think that you're only controlling or only risking say the cost of the spread may be $100, when in fact now you have, $10,000, $30,000, or $100,000 worth of stock you have to contend with. And if you have a small account, obviously you can't manage that. Even if you have a large account, it may limit what you can and can't do. So it may not be a desirable situation for most people. So you get assigned stock. Now, what are the odds of when can you get exercised? Or, well, the short answer is you can get exercised at any time, regardless of where the price is. Now, of course, if you're out of the money, if the option is out of the money, there's really no reason why a buyer of that stock would want to exercise it, because it has no benefit. They'll take a loss. So there's very little chance that that's ever going to happen. So the idea here is that you want to stay out of the money with your short options as much as possible. However, if you're in the money, in other words, you're in a slight losing position, and the buyer of that option is in a slight winning position, then there's a chance that they may want to exercise that at any time. And that could be at any time. All right? Now, the odds of that assignment happening increase dramatically as you get closer and closer to the expiration. When you're far out from the expiration, there's enough premium and enough volatility to take most people off of that game. They simply don't want to exercise, and it very rarely happens. I mean, the exercising of a option is still a very rare event, even when it gets down close to expiration, when it's in the money. So when it's in the money and it's very far away from expiration, the odds are very, very low. And again, only about 2 to 5% of people actually get picked for an assignment. So even if you're down and in the money and close to expiration, there's still a small chance. Let's say you're a week, 2 weeks out, or a week out, a few days out. There's still a small chance, but then that chance grows and grows. And if that stock, if the time is up for that stock and the session closes, there's virtually 100% chance that you're going to get assigned. So the idea is that you want to manage that so that you don't ever get into that situation. And so with our strategy, what we're trying to do is that we're trying to create a strategy that is conducive and friendly to people with small accounts. So they have to think about these things. So when can you get assigned? The short answer is anytime. As soon as you write or open or create a short option, you can be assigned at any time until that option expires. The odds are low, except, I'm repeating basically what I just said, if your short option is in the money and it's close to expiration. The odds increase the closer to expiration you are. And then after expiration, or after, now most options actually close on, let's say they closed on a Friday. That's the effective close, but they actually close on Saturday. So after market, the stock could still move, and you could have started out of the money at market close and then ended up in the money in the extended market. And so therefore you could have gotten assigned when you thought that there wasn't going to be any problem. So that's another reason why you want to kind of mitigate all of this. All right. So what happens in the process of being assigned? Well, that depends on who you are. The buyer exercises the assignment. They're the initiator of the whole assignment process, because they want their stock. So whether it's a call or a put, the buyer either gets 100 shares at their strike price if it's a call option, or they get short 100 shares if it's a put option. On the opposite side, if it's a call, the seller is assigned 100 short shares. All right, it's kind of the opposite here, right? Because it has to be a balance. Or if it's a put, the seller, you, get assigned 100 long shares. So that's the actual thing that happens during assignment. So how can you minimize the risk of assignment? Well, one is that you can buy back short options sooner than later. So in other words, if you buy back your short option, the option that you wrote, as soon as possible before you get close to expiration, you've minimized the chance of you getting assigned dramatically, right? Now, of course, if you're in the money, your odds are much higher. If you're out of the money, then your odds are virtually nil, because there is nobody on the other side that's going to want to exercise their option if they're going to take a loss. The other thing that you can do, well, and in that, buy back your short option sooner than later. So, in other words, try to do your trades in such a way where you anticipate getting profitable or a favorable position well before options expiration comes near. Also, another thing you can do is just never let them expire. Of course, these would all help minimize assignment. The other thing you could do from a strategy point of view is you could roll the short option out further in time to give yourself more time. Again, the further out you put expiration, the lower the chances that it will be assigned. Or you can roll it up in price so that you're more out of the money, you're not in the money. And again, that would protect you as well. As a general rule, what we do is we're looking not to try to get extract every dollar of that options theta collection. As a matter of fact, we're looking for the probability of profit at 50% of the total max profit, or what we call P50. And so when it hits P50, and we're hoping that it will hit P50 very early into the creation of that option, we'll take that profit. Now, we have one position on in our service that almost hit P50 on Thursday, and we probably should have taken it because it was so close to it, but then it moved away from it. So you have to have some kind of rules that say, look, you have to favor taking that profit early as opposed to trying to squeeze every little dollar out of that max profit. Now, if you're so far out of the money that, it's virtually a 99.9% chance that you're not going to get assigned, then sure, you can bring it very close to or right up to expiration, and there your odds are virtually nil if you're, say, 100 points away from something moving, unless there's a flash crash on in the aftermarket. It's unlikely. It's happened. It can happen, but very unlikely. All right, let's go on. Now, one of the things that you can do with a smaller account is a strategy to mitigate risk is the stock selection, your stock selection criteria. If you're going to get assigned, and even if you try not to, you're mitigating that risk. There's still the risk that you could get assigned. So one thing you can do to protect yourself is to never choose a stock that if you were to get assigned with 100 shares, you couldn't cover that 100 shares. So really then what that means is that any stock that you decide to write a call or write a put, just make sure that your total capital in your account can cover that stock, 100 shares of that stock. So here I'm just showing something on FinViz. I selected a bunch of criteria that just chose a list of stocks that I have as candidates to write options against, and they're limited by, they're all under $50. So if you have a $2,500 account and you have 2 times leverage, you can take up to a $5,000 stock purchase, right? So that means that you get 100 shares of something that's up to $50. And so then I can choose any stock that I want to write options against that's up to a $50 stock. Once it gets over that, then I'm at more risk, and so I would rather not do that. And so I'll limit if that's the size of my account. As your account grows, you can check that and then expand the total universe of stocks that you could write options against based on that criteria. All right. Let's come back to the big head. So Daniel's asking, how can you do that in a $2,000 account? Well, I just said that. So if you have up to $2,000 account and you have 2x leverage, that means that you essentially have $4,000 of buying power. If you're assigned a stock that is up to a $40 stock, then that's $4,000. All right, does that make sense? So 40 times 100 is 4,000. So you wouldn't trade stocks. If you had a $2,000 account, you wouldn't write options against stocks that were more than $40. You would limit your, maybe you do a scan and you only look at stocks that are between $20 and $35, as an example. And that's how you would mitigate that. Now, that's really what it comes down to. Just make sure that you can cover that stock. Pretty simple. All right. That's all I have to say. I hope you got something out of this. You have a little better understanding of assignment of stock if you're writing. Now, as I said, this applies equally for people who are going long on taking long spreads or net long spreads. Because you're on the other side, you're going short a stock, and you're probably more than likely taking that stock that might be out of the money in a lot of, or I'm sorry, in the money in some cases. If that's the case, you should be very cognizant of that, because people who are generally, and that's one of the reasons why we don't go for these debit spreads, because they generally are choosing things that are in the money. That's what they're trying to do, as opposed to people who are selling spreads, being net seller of premium, are trying to be out of the money as much as possible. So all around, being a net seller of premium, a net seller of or credit options, is a far less risky way to trade. And in fact, when you're selling puts or selling put credit spreads, the worst thing that can happen is that you're assigned stock. And assigned stock that you, I guess, supposedly would like to own at a discount. So, again, another thing that goes in your favor. Of course, there are many other reasons why we sell put credit spreads. And if you would like to learn more about that, you can join our Discord. There's a link down below. Or if you'd like to take advantage of our service, where we're actually on a pretty good streak here. The service has been around for almost 3 months now. At 3 months, we're going to release the results of Campaign 3. I am fully transparent with my trading account and my brokerage statement. I show it to everybody on virtually every transaction inside of the service. So there's no hocus pocus here. This is just a straight up service that benefits people with small to medium-sized accounts and shows them how they can make consistent profits at a high probability of profit with a decent return on capital, extremely low risk, and do that consistently, very small drawdowns, if any. Actually, we haven't really had drawdowns yet. All right, that's it. I hope everybody enjoys their Sunday. I want to thank everybody for showing up. We'll see you tomorrow.